Open any trading book, and someone will try to teach you 100 candlestick patterns. The abandoned baby, the three-line strike, the concealing baby swallow. Yes, that's a real name. Here's what 300 years of rice traders and 30 years of screen charts agree on. You don't need 100. There are exactly 3 bullish and 3 bearish formations that are easy to recognize, easy to trade, and actually pay. 6. That's the entire arsenal. Today you learn all 6 with the exact rules, including the one number from last episode, 60%. Everything else on that wall? Decoration.
Decision, indecision, decision. 3 brush strokes, 1 signal. The formula hasn't changed in 3 centuries. Let's put names on it. The claim, straight from the method. There are 3 bullish and 3 bearish candlestick formations that are easy to recognize and easy to trade. On the bullish side, potential reversal points at the bottom, the bullish engulfing candle, the morning star, and the tweezer bottom. On the bearish side, potential tops, the bearish engulfing candle, the evening star, and the tweezer top. 3 pairs, 3 mirrors, and every single one of them is built from the alphabet you already own. Decision plus indecision plus decision equals a trading signal. Formation 1, the morning star, a bullish pattern signifying a potential bottom in the market and a potential reversal. Read the story candle by candle. A strong bearish decision candle, sellers in control. Then an indecision candle sitting below. The sell-off stalls, doubt prints. Then a strong bullish decision candle. Buyers take over. Fear, doubt, conviction. The morning star is literally the last star you see before sunrise. And that's exactly what this pattern is, the darkest candle before the market turns up. Now, the lesson that separates people who learned patterns from a book from people who trade them on a live chart. Morning stars come in many shapes, and they may consist of more than 3 candles. The textbook version, 1 perfect doji in the middle. The real chart, maybe 2 dojis, a spinning top and a hammer, scattered at the bottom before the bullish candle fires. Same story, fear, doubt, conviction, just messier. Train your eyes on the realistic version because the market almost never prints the textbook. Flip the sunrise and you get formation 2, the evening star, a bearish pattern signifying a potential top and a potential reversal. Strong bullish candle, greed. Indecision candle sitting above, the rally hesitates. Strong bearish candle, sellers slam the door. It's the mirror image, and the same realism rule applies. Evening stars come in many shapes and can consist of more than 3 candles. Greed, doubt, rejection. When you see that sequence print at the top of a rally, the party is usually over. Checkpoint. Big red candle, doji below it. Big green candle, morning star, potential bottom. Big green candle, spinning top above. Big red candle, evening star, potential top. And if the middle has 2 dojis and a hammer instead of 1 clean star, still a morning star, realistic version. You're not memorizing pictures anymore, you're reading stories. Formations 3 and 4 skip the pause entirely. The market goes straight from one decision to a bigger one. The bullish engulfing candle. After a downswing, a bullish candle completely engulfs the previous bearish candle, or candles, plural. The exact rules from the method. The opening price of the engulfing candle should be equal to or lower than the low or the close of the previous bearish candle, and its closing price should be higher than the opening of the previous bearish candle or candles. In plain language, buyers didn't just win the window, they erased the seller's entire previous move, and then some. The mirror, the bearish engulfing candle. After an upswing, a bearish candle whose open is equal to or higher than the close of the previous bullish candle, and whose close is lower than the opening of the previous bullish candle or candles. One candle that swallows the buyer's whole story. And notice the plural again. A true engulfing can swallow 2, 3,
4 previous candles. The more it swallows, the louder the statement. The last pair has the strangest name and the most precise rule in the whole course. Tweezers. Picture a blacksmith's tongs. 2 prongs, exactly the same length, gripping the same point. Now put that on a chart. The tweezer top, a bearish pattern signifying a potential top. 2 or more candles. Bodies can be bullish, bearish, doesn't matter. But at least 2 of them print long, equal wicks on the north side. Equal within a couple of pips, points, or ticks, whatever unit your market trades in. Twice, price spiked into the exact same ceiling, and twice it was slapped down at the same price. And here is the number I promised you. For a tweezer to be real, the wick must be at least 60% of the total candle, and the body no more than 40. Wick 60, body 40. That ratio is what separates a real double rejection from 2 random candles that happen to line up. And formation 6, the tweezer bottom, the bullish mirror. 2 or more candles with long, equal wicks on the south side, equal within a couple of pips, points, or ticks, wick at least 60%, body at most 40. Twice, sellers drove price into the same floor. Twice, buyers bought it back, to the tick. That floor is defended. 6 for 6. You now know every formation in the method that's worth your money, and the exact geometry that makes each one valid. Freeze the frame. Here's your new wall. 6 formations. On the bullish side, the engulfing that erases the sellers, the morning star that turns fear into conviction, the tweezer bottom that defends the floor. On the bearish side, the engulfing that swallows the story, the evening star that ends the party, the tweezer top that rejects the ceiling twice. Print it, burn it in. When one of these 6 prints on your chart, the market isn't whispering anymore. It's making a statement. Why did the method keep exactly these 6? Because trading candlestick formations offers the best risk-to-reward opportunities a trader gets. They're potential turning points, and when you trade them in the direction of the trend, they have a high chance of paying off. They also lend themselves to what the method calls a tight stop. You risk very little compared to the potential reward, and if a formation fails, your loss stays small. Keep losses small, let profits run. That's the entire philosophy. But knowing the 6 shapes is only half the job. Where do you enter? Where does the stop go? Exactly. In pips? When do you walk away? That's a protocol, and it's next. Final check, full speed. A giant green candle that opens below and closes above the entire previous red candle, bullish engulfing. Rally, then 2 candles spiking the same ceiling with 60% north wicks, tweezer top. Red candle, messy cluster of dojis below, then a strong green candle, morning star, realistic version. 3 for 3? Then you officially know more about candlestick formations than most people who paid for a course. Yours was free. 30-second recap. 6 formations, 3 mirrors. Engulfing. One decision erases another, opens beyond the previous close, closes beyond the previous open. Stars. Fear, doubt, conviction at the bottom, greed, doubt, rejection at the top. And they can be more than 3 candles, so trust the story, not the textbook. Tweezers. Equal wicks into the same price. Wick at least 60%, body at most 40. Now here's the truth nobody puts in the thumbnail. A perfect formation, traded without rules, still loses money. Next episode is the one professionals actually care about. The complete trading protocol. The 80% trendline rule. The 60% U-turn. The protective stop at exactly 15 pips above or 10 below. Why the market tests your formation more than half the time. And the 4 past lows exit. Episode 4. Same playlist. Grab the cheat sheet in the description. Page 3 is these 6 formations, and I'll see you at the protocol.